NPG, the New Producers Group, is a collaborative network developed over the last 8 years. It's built on trust and peer-to-peer exchanges, and it brings together governments of over 30 countries. Our member countries want to avoid the past pitfalls of managing their petroleum resources, so the group really works to bring together the best advice and exchanges to help them manage their assets effectively, and also prepare for the world beyond oil and gas. So this meeting comes very much in the context of what we've seen happen in the oil market. Prices of oil and gas have fallen dramatically over the last few months, both due to the price war and COVID-19. And while there's some rise in response to production cuts, that's unlikely to last, and it comes in the context of an ongoing energy transition and efforts to stem climate change. So today's session comes in this context and as part of the Fostering Resilience series that the NPG is running. And our focus is on how different financial actors perceive the relative risks of oil, gas, and renewables in the post-COVID world. I think our members rarely get insights into thinking in the world of finance and investment, particularly in power sector investments. So we're really delighted to have with us Lucy Heintz, a partner in energy at the Investor in Emerging Markets Actis. She will be followed by several expert respondents from different fields. These are Paulo Martins, a senior expert and team leader at DG NEA, which deals with the EU's external investment plans. Beth Mitchell, an independent investment analyst, many years experience of working with funds in the city. And Leila Benali, chief economist at the Arab Petroleum Investments Corporation, APICORP. I'm going to run this more like a discussion panel. So I see many familiar faces, many familiar names rather, not faces. I see many familiar names, and you know, it's a really great group of experts on the call. So I think this will be a rich discussion, and so I hope that you join in with that and think of your comments and questions as we go along. Bit of housekeeping: we only have 90 minutes on the call, so I may have to cut in to make sure that there's time for everyone to speak and to have time for the discussion. But I know there's a lot to say, so use the chat function, which is at the bottom of your screen, if you want to add to your comments or if you think of things to say as you go along. But I think during the discussion, it's really great if people can raise their hands. So if you see the button near the bottom of your screen on participants, you can use that to raise your hand if you'd like to make a comment or ask a question directly, and then I'll call on you, hopefully if we get round to everybody, and you unmute. We'll unmute you, or you unmute yourself. You may have to do that as well in order to ask the question. So we'll try and get through as many comments as possible during the discussion that way. We hope that you had time to have a look at the two scenarios that Valerie sent out earlier, because they'll help us focus our minds on, you know, what could be happening, say, in 18 months' time. The first is a world in which deeper recession takes hold, with countries becoming more inward focusing and protective, oil averages at about $15 a barrel, and the second is where there's greater international cooperation and a bit more of a focus on green recovery. Of course, you're all welcome and encouraged to challenge these. Nothing's set in stone. It's just to help us think around what the fallout from COVID might mean for private, state and multilateral financing in energy, and how in turn that might affect countries' prospects for sustainable transition in the long term. So we're really lucky to have pulled Lucy from her busy schedule to give us a few insights from her experience. Lucy has worked mainly on power sector and infrastructure investments with Actis, and before that with Glada. I'd like her to just, Lucy, if you can just tell us a bit about Actis and where you invest, that would be great.
Thank you so much, and thank you for the invitation this afternoon. Actis is a private equity fund manager, and we invest only in emerging markets of Latin America, Mexico South, Africa, including sub-Saharan Africa, and Asia. I belong to the energy and infrastructure business of Actis, and through that, over the last 20 years, I've been at Actis for 19 years, we've done over 115 different power projects, over 80 of which have been renewable, and the remainder largely gas, but we have historically invested in other technologies as well. You won't necessarily have seen our name, but you will have potentially come across the names of the companies we invest through, such as Globelec or Leila or Biotherm, Atlas, Echo, Ostro. We've actually built 15 different generation businesses over the last 20 years. And we've also invested in 3 different electricity distribution businesses, including Umeme, which is the distribution concession in Uganda. We're very focused on responsibility. We invest with impact, and we look to build partnerships with governments so that we can invest repeatedly in markets. And we also invest across the whole value chain in the electricity sector. I might give you the example of Senegal, where we have just commissioned West Africa's largest wind farm at 158 megawatts. And at the same time, we are partnering with the Senegalese government around a battery storage solution, which will strengthen the grid. And also we have invested in the HFO plant in Senegal with the very express intention of working with the Senegalese government to convert those to gas, which again is a big part of Senegal's low carbon, low cost energy transition. So we see a big opportunity in wind and solar, which is cost competitive across 80% of the planet, and is a very big component of growth going forward in the markets that we invest in. And in gas as well, which remains very important in terms of baseload, where electricity demand is high and levels of electricity access are relatively low, but is also very important as a bridging technology, and also in terms of providing flexibility to back up wind and solar in markets which currently don't have a lot of import and export balancing capabilities. Let me stop there, Glada, thank you.
Sorry, I was on mute. Thank you very much, Lucy. I also forgot to mention that this meeting is on the record today. It's not being held under the Chatham House rules. So if you do want to tweet about it today, you can, and you can use the hashtag NPG resilience, which Valerie has just put in the chat. So I'm going to ask you a very broad question first, Lucy. If you're thinking, say 18 months ahead, do you think the COVID-19 crisis will have affected your risk perceptions in emerging markets and the kind of decisions that you've been making, say, around gas and renewables?
So there's lots of pieces to that question, but in big picture terms, if you look at the World Bank Economic Outlook that came out last week, there are very high levels of GDP reduction this year, but actually quite high levels of rebound next year, which are being forecast. And that clearly has implications for electricity demand, which has gone down dramatically as a result of lockdowns across many of our markets, but actually is already seeing signs of rebounding as economies start to recover, or certainly even just to unlock down. In general, the fundamentals for electricity growth in the markets where we invest are very strong. Levels of electricity access are actually relatively low compared to OECD or North American and European comparables, and actually there's very high levels of suppressed demand. So we actually see still a very long-term positive outlook in terms of growth in electricity demand and the need for infrastructure, which is not changed in the short term by the sort of impact of COVID.
Yeah, that's interesting. I mean, I think this issue of attaining universal energy access and the fact there is all that latent demand, the idea now is to put in place more resilient, more sustainable energy infrastructure to meet that demand, and that does require a long-term investment outlook. So I think some countries are feeling it's becoming harder and harder for them to attract that kind of finance in spite of all the green finance opportunities out there. So, you have the banking regulations that came in after the 2009 financial crash, and now you have this, which is weakening economies of countries that were already heavily indebted. You know, I guess a lot of the countries in the new producers group are interested in building the value chain around their extractive resources, but also harnessing solar and wind and in some cases geothermal energy to drive their economies. What are your thoughts on kind of short-term versus long-term investment in the sector, given how things might play out, say, under the 2 COVID scenarios, you know, and what do you think your industry needs to see, if at all, in terms of the multilateral finance support from the MDBs?
So I think there's 2 main points really. Firstly, on your multilateral point, I think there is a lot of support available and a lot of expertise in terms of building other programs. And you know, I think that, you know, I like the kind of global cooperation is clearly better for a, you know, a recover better type of scenario. And I think that, you know, there is a lot of, you know, the World Bank is providing a lot of support. I understand that 100 loans were approved even to the end of April. So there's a very high level of activity, a very high level of support. Of course, there is a very high level of economic impact, but there is, you know, as part of that, potentially an opportunity. And that comes to my second piece of the answer, which is that there are some great examples around growth markets, emerging markets, of countries which have really succeeded in bringing in a lot of foreign direct investment to their countries, particularly around renewable energy investment. So you take the example of India, which has enabled an enormous proportion of its population to have electricity access over the last 10 years and has a target of 400 gigawatts of renewable energy by 2032, which is like building a whole new India of wind and solar projects. You have the example of South Africa, which launched a really successful renewable energy program, which had very clear framework, very clear rules, very large ambition, and therefore it really encouraged suppliers to commit to building local skills in the supply chain. It encouraged investors to commit in terms of there were multiple chances to win and invest. It encouraged lenders to really learn the risk and build insight in the sector, and it encouraged a whole industry around project development and all the other skills that are required. And actually what's happened in South Africa is that through 4 rounds of bidding, electricity prices for those tenders have come down by over 70%. So there are some very clear frameworks of success to look at that, you know, have shown what can be done. And so all the expertise and tools are out there. And South Africa's program was actually done without inbuilt World Bank support. There's World Bank support that kind of came on the original kind of genesis of it. But you know, there are some great examples out there in terms of bringing in FDI and, you know, really translating that into jobs, lower cost energy and lower carbon energy.
Thanks. And I mean, I suppose lastly, if you were thinking about the actual transition dynamics, I know you mentioned the HFO plant that you financed in Senegal. You know, how do you see that playing out? Because I know the idea is to then convert that to gas, which is seen as a transition fuel for some, but for how long, and how do the economics work out there? You know, what do you think governments need to do to get that right? I think that's some of the biggest questions that the countries are asking right now, is how they manage for the flexibility, or how they manage for the long term when they're planning their energy sector and wanting to attract FDI that also matches that transition.
So my experience is really on the energy and electricity sector. So I'm not an oil and gas expert, except where it relates to electricity. So it's a very large group of people on this call who will know much more about some of these aspects than I do. I think what's important is that oil prices and, you know, are global commodity prices. And one of the important things that we see policymakers thinking about is using, you know, their natural resource endowments to earn foreign exchange, which is very valuable in terms of then economic growth and building economies. And if you had a natural resource endowment of wind and solar, actually that can create lower volatility in your electricity pricing and lower volatility therefore in your kind of accounts, because if you're importing oil, then you are using that FX to import oil as well, and import both the commodity price and using your foreign exchange reserves. And we have seen a large number of successful projects where, you know, the opposite is true. By using a country's own reserves, reducing volatility is important, and saving foreign exchange is really valuable. And I would give you the example of the Songas project in Tanzania, which we invested in through Global, which saved, you know, nearly over $500 million of foreign exchange over a 5-year period, and that is also, you know, extremely valuable in terms of thinking about utilizing oil and gas versus wind and solar.
Thanks, Lucy. It's really fascinating, and I think, you know, a lot of questions will come up in the discussion about those particular country projects. Maybe Paulo, I could turn to you. Are you on the call? Let me see. Paulo, are you?
Yes, I am.
Great. Okay.
Good
Sorry,
afternoon.
I can't see everybody on the screen. So, Paulo, you manage the external investment plan for DG NEAR, is that right? And it's Fund for Sustainable
Yes.
Development. So, do you think the EC's appetite for and risk assessment of guarantees for renewables and other types of energy projects in emerging markets has changed or will change as a result of COVID? And did anything, you know, Lucy say, anything that Lucy said strike a chord with you?
Well, good afternoon, everybody. Indeed, what she said was very interesting and very valuable to us. In relation to renewable energy, let me reassure you right away, the crisis has not changed our appetite to invest and to allow other investors to bet very strongly on renewable energies. For us, it's a structural choice that we have made a long time ago. The whole Europe is betting on this transition in the long term, but a transition that we realize we have to do very quickly in terms of the capacity that we have to implement things on the ground. It is something which requires to move very quickly. So the Commission and the European Union in general is committed as much as before on these technologies, and therefore we have not changed this commitment. And in fact, as if you are attentive to the Commission proposals, 2 weeks ago we have proposed a response package to the economic fallout of the crisis, which is quite significant, including for emerging markets, including for our partner countries, and will allow us to more than double the guarantee coverage that we had planned or we had proposed 2 years ago. Let me stress that this is just a proposal from the European Commission that has to be approved by the European Council and the European Parliament. So it's a very long process in the legislation process that usually takes place, but we hope that this time it will be faster. So for the moment, it's just a proposal, but if it's approved, and we hope it will be approved, we have good signals, initial signals from in that respect. It will more than double our capacity to guarantee investors that their investments in renewable energies, but also in other areas, of course, but renewable energies will be one of our core areas of support. Will reassure them that their investments in the long term can be guaranteed by the Commission and by our partner financial institutions in order to make sure that the investments are not subject to uncertainty and the risks involving emerging markets. So this is our clear choice that is continuing. Of course, the crisis will bring about the need to invest and to support a large set of areas, a set of large number of sectors, because the crisis has hit many sectors indistinctively. but the renewable energy sectors will continue to be a choice of the Commission for the next few years.
That's great to hear. I mean, I think this issue of guarantees, offering guarantees, has really risen up the agenda in terms of building a viable renewable energy market in emerging markets. And you know, I mean, do you think that there'll be any problem with the public capital given growing deficits in European countries?
Yes, that might be a problem for a lot of public budgets to continue supporting this transition. But I think it's a good moment. Also, from our point of view, we have to focus more on private investments, because we are talking about private investments that can be profitable, especially in emerging markets which have high growth perspectives, and therefore it is important for us in this sector specifically to use more and more private investments. With our guarantees, we hope to de-risk these investments in order to make them more attractive, and therefore for the public sectors in some countries there might be more difficulties in supporting this transition in a large scale, but we hope that this is something which is transitional, which is temporary, and can be solved in the next few months or perhaps 1 or 2 years. But from the Commission side, rest reassured, we have asked for a reinforcement of our guarantee budget, and that reinforcement will go to the crisis, but the basic budget that we had foreseen will continue to focus very much on renewable energies as one of our top sectors, and therefore our will to support that sector is not changed.
Do you have particular focus countries or regions, say over the next year and a half?
Well, that we leave to the private investors, as Lucy that has talked before me. I think from the Commission side, we want to support all countries, especially developing countries and least developed countries, because we realize that for those countries, first, private investors have a much more high growth perspective, and second, these countries need much more coverage of electricity than more developed countries or countries in a middle income situation. So for us, it's very important to focus more, because that's where our additionality might be more interesting on more or least developed countries, or more countries which are more in need for these type of investments. But in any case, our coverage is all around the world. We cover, in terms of cooperation, more than 100 countries in the world. So for us, there is no priority countries, except, as I said, for least developed countries. Otherwise, we cover all the countries, and we hope to support all the requirements from private investors and private financial institutions that come to us without problems, because we have quite a hefty budget to do that.
And do you think that, you know, of course, countries undergoing recovery will be looking to create jobs first and foremost? Do you see any conflict between that and the green objectives for public lenders?
You know, if we are talking about countries where electricity is covering a very small part of the population, or perhaps a large part, but with a lot of cuts during the day, and therefore there is no reliability on electricity, these countries require electricity to start thinking about development in a more consequent way, in a more reliable way. This is the basics for any country, for any development. And if you're talking about jobs, electricity is something that is the basic item that is necessary to secure more jobs with more added value and more capacity to generate revenues for the country. And therefore, if we are talking about energy, this is the basics that are necessary for all sectors to work. And therefore, for us, it's a high priority area exactly because of that. So there is no conflict. On the contrary, the energy is necessary to everything else that we plan to do in terms of development, and therefore there is a priority for this in any situation, on any possible crisis that happens in the future. That continues to be a priority sector.
Thanks, Paulo. It's a very robust view from the European Commission, which is good. I wonder if I can come back to you, Lucy. Just you know, if countries are thinking about what, you know, how to plan forward, how to plan their recovery, and perhaps make some changes to regulations and reforms that affect the power sector. You know, do you have any thoughts on what you'll be looking at in terms of the regulatory and investment environment?
Thank you, Glada. So there's a few things that are important, but as I said, there are lots of great examples of those structures already being used in parts of the world. A clear framework, support in terms of a country's transition from potentially not being a credit-worthy electricity sector in its own right to, you know, maturing and potentially heading in that direction, which is what, you know, the journey that many Latin America countries have already taken. So some kind of guarantee facility or credit support is very important. In the longer term, you know, cost-reflective tariffs are really important in terms of sector sustainability, and that in the long term is what, you know, is the best ingredient for foreign direct investment success, because sectors that, you know, are commercially sustainable without subsidy then don't need guarantees anymore, and so it's kind of a transition. So clear frameworks, some kind of credit support, and then, you know, what we talked about previously in terms of South Africa, you know, large ambitions and scale programs are really helpful in terms of then bringing a lot of investor attention and delivering, you know, allowing that country to capture the efficiencies of multiple rounds of procurement.
Thanks, I think it's really useful. So maybe we could, so we've talked a bit about the power sector and renewables. Maybe we can turn to you, Beth. You know, as you know, a few years ago, my colleague and I wrote a bit about what carbon risk looks like for producing countries, particularly developing producers, and how the investment community is turning away from oil and gas, or, you know, could turn away from oil and gas given the various risks, you know, given the exposure that it's seeing for stranded assets, for instance. How do you see, you know, what do you hear through your investment community networks in terms of the appetite for oil and gas, and you know, how do you think COVID is likely to affect that? And maybe in particular, you know, people talk a lot about the possibilities to maybe snap up cheaper oil and gas assets that some companies are having to let go of. Do you think there's the same appetite that there was a few years ago for the resale of oil and gas assets?
Well, I think there are several parts to that question. Starting by saying investors are not one homogeneous lump. There are lots of different categories of investors, and they go from the super ethical to the running dogs of capitalism, and from the extremely short term to the very long term. So you have to really think about what different constituencies want. But I think it is well worth saying a couple of things on a more general basis. First of all, remember that, and I'm talking about equities, so shares in oil and gas companies, have been underperforming for a long time. I mean, they've really been underperforming for about 15 years. And even when the oil price was high before 2015, the returns shareholders had been getting from oil and gas company shares were pretty disappointing. Partly because there was an element of value shifting towards producing countries, which may or may not be a good thing, partly because so many projects were late and over budget. The thing that I think has really changed over the last, say, 5 or 6 years is the appreciation of the carbon risk to which you were referring. And that has happened both within the investment community and also, to quite a large extent, within the companies, the risk to their businesses. and therefore for investors in company shares, the risk to their investments. And whereas, say, 10 or 15 years ago, ethical investment would have been a small desk sitting, you know, somewhere over there in the corner, investing quite separately, particularly the risks relating to climate change have now become central risks, which are considered by all investors. So normal pension fund investors, non-specific investment. And those fall into the risks to your actual assets. You know, are they going to be flooded if sea levels rise? The risks of litigation, if you are found to have contributed to climate change, and the risk to your business that you will be selling less oil and gas in the future because of actions that are being taken to mitigate climate change. All of these things make oil and gas company shares less attractive. Now, when we add to that COVID, I think what we really see is the gearing also that we see over and above any transition away from oil and gas. We see the gearing to economic growth. And certainly if we look at forecasts, real world forecasts, or indeed Valerie's scenarios, you're looking at very significant falls in demand. And bear in mind, we've spent the last 5 or 6 years talking about when will peak demand happen. Well, peak demand's already happened in OECD countries. The only demand growth we were expecting was from emerging countries and through things like petrochemicals. Now, if we have very, very subdued economic growth, or indeed a massive recession with a very slow recovery, as per your less cooperative scenario, then you see that gear into a much lower oil price. And that gears back into the prospects for the companies, in the sense that they will then look at their projects and say, well, far fewer of these are actually economic. And you'll have maybe seen today that BP has announced a very big asset write-down on the basis of a much lower assumption for what the oil price will be going forward. They've just announced, I think it's $17.6 billion, $17.8 billion, short over $18 billion, right down to how much their oil and gas assets are worth. And those were on assumptions far less extreme than either of the scenarios that we put forward for discussion. So you can see how that then becomes a situation where companies which have already in general announced large capex cuts, order of magnitude 25%, if things turn out worse than that, then those capex cuts will come harder and faster. And that means that fewer projects will be delivered, fewer projects will be started. The projects which will be started and invested in will need to be better projects. They will need to be more resilient at lower costs. They will need to be in countries who are easy to deal with. And so I think in general, it sort of moves us forward through the transition to a point where oil and gas companies are less attractive investments. They're doing less investment. They have less growth. Now, of course, there may be some super cheap assets that some opportunist companies may wish to pick up, but that requires them to have access to funding, which many of the oil and gas companies don't, because of course, or have less under that scenario, because of course, the assets that they've just written down are the assets against which they'd be borrowing. And secondly, when we think about private equity sees lots of opportunities in renewables and proper growth sectors, such as Lucy is offering, and rather fewer in oil and gas, which is, I think, everybody thinks a bit more of a sunset industry. And they've already invested very heavily since the financial crisis and have a fair few assets which are quite highly geared. So I don't know quite how much. I mean, obviously, if things are very, very, very cheap, somebody will come in for them, but they may not necessarily be right. So I think in general, we've moved quite a lot further through the process of alienation of investors from oil and gas than perhaps we would have thought, due specifically to COVID, making everything a bit more extreme.
I think that's fascinating, Beth, and definitely has implications, ramifications for how countries think about their regulatory environment for investors and their contract, the way that they produce contracts. Leila, so you've just released your APICORP's investment outlook, I think today. I haven't had time to read it, but I would love to hear your perspective on some of the points that are the panelists have raised, and maybe also a little bit more on where you see energy investments going, not only in oil and gas, but also petrochemicals. And, you know, if you see some kind of restructuring of the value chain post-COVID.
Right, thanks, Glada. There are a lot of broad questions that were discussed so far. So I'll try to structure my thinking along, I would say, four different points. I'll start with the investments outlooks. I mean, the IEA released its own investments outlook last week. I have the privilege of being one of the peer reviewers, so I had access to, let's say, the data or the messages before they were released. And there were a lot of similarities between the IEA's global energy investments outlook and APICORP's regional energy investments outlook, in the sense that both organizations were seeing, of course, a cut in energy investments, an immediate cut to energy investments, which starting in 2020, compared to previous downturns where the cut was delayed, let's say, by a year at least. And I think the magnitude also of the cuts were much deeper than what we saw in the past. So taking that into account, we reach more or less the same aggregate declines in the region compared to the world, but there are some, I would say, pockets of opportunities and good stories, and I would like to highlight the increased investments in the gas sector that we are seeing in the region, that continue to be in place in the region for strategic and domestic reasons as well. But I'll let you read the report so that you can have a look into some of the insights that we shared, including the share of the private sector that has decreased this year compared to last year in the region. And part of it is also due to a lower investments being planned in the utilities side of the business, where we see typically in the MENA region a high share of the private sector compared to, I would say, oil and gas, where you see the private sector only active in services, in providing those services. And this private sector, I think across the board, has been hit quite hard by the current crisis. I think from a macroeconomic perspective, I just wanted to react to some of the points that were mentioned early on. We run with the assumptions, and I saw Chatham House 2 scenarios, and we definitely share the fact that one of the main factors that will affect the pace of the recovery is the coordination or lack of coordination between countries in terms of their management of the crisis, of the management of the crisis, health-wise, economy-wise, and financially as well. And I think that's something that that underpins our assumptions when it comes to the pace of the economic recovery. We see more of a W shape, to be honest. The level of oil prices that we see in the next couple of years, and the commodities prices across the board that we are seeing going forward. So I'm afraid on an aggregate level, we are talking about a slow and prolonged recovery and a much longer time frame for investments in the energy sector across the board to come back, and particularly in this region. Now, one issue that I'm also facing is, and I've been saying that since March, is that don't trust the economists, simply because the economists are not used to model pandemics like acts of war or natural disasters, where you have a complete, I mean, not a complete, but at least a simultaneous destruction of productive capacity in the economy and in the energy sector at the same time. So I think the -5%, the -3% of global GDP growth rates that the IMF and the World Bank have issued will be revised downwards. And I think we all know that, and we have to be ready for that, because we are still starting to take into account the second and third round effects this crisis, people have lost their employment for a number of years, companies that went into bankruptcies. Beth has mentioned the destruction of value in some companies. So all these aspects will have to be taken into account. Now, I have also some bullish factors in my story that are potentially bullish also when it comes to energy demand. The fact that the way we will be consuming demand in the future, and there might be a rebound effect that will have to be taken into account, might prevail. But at the same time, I think as of today, the bearish factors are much more, I would say, powerful than any bullish factors that you can think of. So I think that gives the overall energy perspective. Now, when it comes to oil and gas versus renewables and utilities, I agree with what was mentioned early on. I mean, it's true that the energy sector across the board has delivered very low returns for shareholders over more than the last decade, and it has been penalized because of that. So investors, compared to I would say IT or real estate or other sectors, investors have preferred to go to those sectors because they're simply delivering more returns, in addition to the carbon risks, the risk of stranded assets that were mentioned early on. So from that perspective, I think there could be a bright side of this story. I like to think that the energy sector as a whole, including the oil and gas sector, could emerge out of this crisis more consolidated, more integrated. It will entail a lot of mergers and acquisitions and a lot of cleaning in the balance sheets being done, and the numbers that were mentioned by Beth in BP's writing off part of their balance sheet. But that's also related to the fact, if you compare that to the national oil companies, and I think that's the purpose of this group, is national oil companies typically, I mean the majority, I'm not going to put all national oil companies in the same basket, but generally have been quite conservative in their oil price and gas price outlooks compared to the IOCs, and that's a huge generalization. I agree, but in general, particularly I would say the low-cost national oil companies were, I would say, in the last decade or so, very cautious, because the carbon risk in a way was already embedded at the end of around the last financial crisis in 2008, 2009. The risk of the carbon risk was already embedded in several scenarios, simply because they have much lower diversification options than international oil companies that are integrated and can go, that can actually have an international portfolio in a larger part of the sector. So I think there will be, from that perspective, additional integration. And I think the crisis or the global reset that we are seeing today is accelerating a trend that was already in place, because a lot of those assets were undervalued, as it was mentioned early on. So the integration drive that we've seen in the past few years towards more downstream, a bit more downstream in the value chain, but also towards electricity. And you see that among some of the IOCs, but also among some of the smaller independents and national oil companies, a drive to play a role in electricity, not just to serve their own needs or their own consumption. So we will see some targets, usually, as Beth mentioned, will be the lower valuations, distressed entities, but there will have to be a lot of cleaning being done. The other parts of the value chain that might see some interesting movements, I think, is in the midstream part of the chain, where, I mean, you are aware of the ADNOC deal on its pipeline infrastructure. You might see some of those assets also being partially privatized in other parts of emerging markets. On the utilities side, and I want to probably finish on that so that I don't monopolize the discussion. yeah, I mean, we've seen a lot of already, I would say, fragile utilities being hit by in their financials. I'm thinking about the Jordanian national utility, the Omani national utility, etc. But overall, I think in the region, in the Middle East and Africa, the national utilities have been taking the hit when they have an issue with the revenue collection. More than anything else. But overall, I think when it comes to renewables per se, even I would say if renewables can be perceived as one of the most interesting sectors in the infrastructure sector from an investor perspective, we're still in a situation where investors generally prefer to have, especially for conventional funding, market capitalization, dividends, liquidity. So these are not conditions that are being offered by, I would say, a renewable stream today. So conventional funding is definitely available for, you know, the large scale, well-rated companies, but the smaller players that are typically testing also new technologies or penetrating new markets, you know, have to recourse to non-conventional funding, mini perms, aggregation of projects, crowdfunding in some cases. So my concern is really not there. My concern for the renewable industry is elsewhere, is the fact that the solar PV, more specifically, especially in the Middle East and Africa, because of the and some parts of Latin America and Southern Europe, has benefited from the decrease in costs. There's no doubt about that. My issue is with the rest of the value chain, the storage, the intermittency legacy. I mean, all those issues that have to be dealt with from a technical and regulatory perspective is still missing. And when it comes to financing, for example, if I take the example of storage or even gas-fired plants, we're not at the stage yet in several of these countries to have recourse to conventional funding. So that's, I would say, on the negative side for the renewable part of the story. The positive side is that today we have locked down 40% of the population of the world, and you have 4 billion people who were subjected to some form of confinement one way or the other during several weeks, and we still haven't reached the targets of the Paris Agreement. So I think there will be, and there is an increase in awareness, including among the investment community, that much more needs to be done, and seriously. So from that perspective, I think it's quite key that, and I see that in several countries in the region, including Morocco, when I'm part of, that's my other hat, part of the Royal Commission for the Development Model. We are looking into possibilities of exporting green electrons in embedded products, ammonia, steel, cements, but also hydrogen. So, and that's official now, because the ministry has announced its agreement with Germany on hydrogen drive. But this is the thinking. The thinking is to transform the availability of a solar potential into development schemes for not only the industry, but the society as a whole in those countries.
Yeah, I think that's fascinating. Really interesting discussion for another producers group meeting. I think that change in the restructuring of the value chain there. I just wanted to ask you specifically what you thought about for a long time, the countries in the region have been looking to Asia as their growth market, and also as petrochemicals as a way to diversify the economies. Do you think that still stands? I guess they're looking very closely at what's happening in China and India.
Yeah, I mean, it's a pity that today Beijing announced the fears on the second wave of the coronavirus. So all the story that China is coming back is a bit weaker today as compared to last week. So it's quite difficult to see how things will emerge overall. But I still think that once the fundamentals are back to a, I would say, normalized level, you would still see the pockets of growth coming from, I would say, the same culprits and the same areas. So definitely China and other parts of Asia will continue to be a major source of demand. And you're right, Glada. I mean, a lot of the drive to integrate the oil and gas part of the value chain with the petrochemicals part of the value chain, and being able to again cut costs and have operational efficiencies across the value chain was the drive was to ensure that you convert from one market, which is basically transportation, to another market, which is plastics. So today, I think that drive is still valid, and that's the reason why, for example, if you look at our investments outlook that we issued today, we didn't change much the story on the investments as far as petrochemicals are concerned. I think most of the economically sound projects will still go on as planned. The issues are with those projects that were already, I would say, questioned before the crisis. So you have the Nebras in Iraq, the Tahrir in Egypt, the Iranian portfolio. You have $6 billion of petrochemicals projects planned in Iran. So, but these would be affected by other factors than the current crisis. So I think from that perspective, the fundamentals are still there to continue to have an integrated, diversified portfolio, and that has actually an impact on the, I would say, the energy company of the future that we will see emerging, I think, over the next 5 years, where you have those concentration of larger entities closer to institutional investors, including the large ones, the sovereign wealth funds and others, who have that long-term view in terms of investing, and are able to continue that long-term bet on particularly the petrochemicals, because at the end of the day, you are diversifying the economy of a whole country by doing that, and that's a long-term bet that you are taking. So for now, I think the fundamentals remain. There will be some correction.
It's obviously a very different consideration, isn't it, for a country like Iraq, you know, that doesn't really have the industry, compared with the Gulf countries that have, you know, established their petrochemicals industry during the 80s. So yeah, there's a lot more to be said about that, but I want to move us on to discussion. Thank you very much, Leila and Beth, Lucy and Paulo, especially for being so concise and succinct in your answers. We're obviously covering a really, really broad range of issues here. So I want to open up for discussion. Please feel free to raise your hands, and I think Valerie will help to moderate this with me so that we can unmute people to speak. We have one question already from Fahad Alidi, who says, for most discussions on renewable energy, we start the conversation with how competitive renewable energy is today, yet we still ask for significant public funding incentives and support. How do we reconcile these two things? So I think maybe that's a question for you, Lucy, to start with, and anyone else who wants to come in.
It is, you're right, it's a question that does come up, but in some ways it feels like a question that isn't perhaps as current as it was, because renewable energy is already cost competitive without subsidy. It's actually 2/3 of the planet, and by 2030 that will be universal. I said 80% earlier, but I meant 2/3. And if I give you statistics from recent auctions in markets where we operate, I think you'll agree it's just low cost energy. So Ethiopia had an auction for solar and wind solar projects, $25 per megawatt hour without subsidy. Tunisia had an auction for solar projects, $27 per megawatt hour without subsidy. We just closed a project in Egypt where the tariff was actually awarded 2 years ago, 2 to 3 years ago, and that is $38 per megawatt hour without subsidy. So, you know, I think by anyone's calculations, that compares to coal or gas power, even sometimes from already operating coal projects where you're just looking at the marginal cost. That is, you know, properly cost competitive energy by any measures that you could think of. And even when you integrate storage now, and there's been auctions for solar plus storage in places like India, but there's actually recent there's recent auctions as well in the US, and actually the difference once you integrate storage, which can create, you know, not necessarily 24/7, but, you know, more reliable power, you're only adding $5 to $8 per megawatt hour. So, you know, even when you're trying to compare apples to apples in terms of the reliability of wind and solar versus reliability of coal or gas, you are in cost competitive territory.
I can add the banking sector perspective if that helps.
Yeah,
I think part of the answer to Fahad's question is also related to where the banking sector is standing at today, because utilities in general are still financed through a large portion of debt and a small portion of equity, versus compared to, I would say, oil and gas, where it's the other way around. So we still depend on the appetite of the banking sector. If you want to fund it conventionally, that's why I was making the difference between conventional funding and unconventional funding, to make those projects appealing. Now the issue is that what's happened, especially in the Gulf, is a huge competition among banks, which has led them to what we call the profitability trap, that it could not enable them basically to provide additional funding at more competitive pricing for some renewable projects. So even if in theory you would say that the costs have decreased and why don't we put solar panels everywhere, there's still a financing and financing issue, a funding issue, especially when it comes to the debt side of the business, that is still has not been solved before the crisis. Now the crisis, as I was talking about the restructuring of the energy sector, even if the banking sector arrived to this crisis in a better shape than in 2008, with higher banking capital ratios, I think of 12 to 14% compared to 7 or 8% in 2008, we might see consolidations in fragmented markets, and the Gulf is one of them, where some banks there will be some potentially mergers among banks to be consolidated. So you might see, hopefully, a solution to the funding issue that we have been facing in some of these regions when it comes to renewables.
Thanks very much, Leila. I mean, I certainly noticed that countries are looking more and more at how to attract the finance in the grid and in storage and in the whole infrastructure that is needed to support much higher renewable energy targets, and that's I think that's something that we will continue to see. So I am just looking to see whether anyone has raised their hand. Please do. You see the participants button at the bottom of the screen. You just click on it and you click on the raise hand function if you'd like to make a comment or ask a question. Maybe I could ask Hiroki, are you there? Hiroki Sekine? Hiroki Sekine?
Yes.
You were Director of Policy and Strategy at the Office for Financial Operations at the Japan Bank for International Cooperation. Is that right?
Yeah. Can you hear me?
Yes, I can hear you great, Hiroki.
Okay, thank you very much for giving me to make some comment on that. But before that, thank you very much for very interesting and great discussion among panelists. Today's discussion is very nice and fantastic. I'm Hiroki Sekine from Chatham House and a visiting fellow from Japan Bank for International Cooperation. So my background is very finance. I have worked for Japan Bank for International Cooperation more than 20 years. And I was there in a lot of discussion and the transaction related to oil and gas and renewable energy. And today we had a lot of discussion on renewable energy and future transition to green projects. So still, I think the financial sector has a very strong appetite on renewable energy because we would like to shift more to the green related transaction, and the banking sector would like to replace the conventional asset by the more sustainable asset. So we actually have a lot of strong appetite on the renewable energy. But disadvantage of renewable energy is that renewable energy, particularly in solar power, doesn't guarantee the sustainable supply to the national power grid. So if you would like to add more renewable energy, so some innovation is necessary. So today, I think the Leila described a little bit about the possibility of hydrogen. So I think to introduce some new technology in the renewable transition is a good thing. And one of the very dramatic change to be introduced by new technology. One of the possibility is hydrogen. The other one is large-scale power storage, like large-scale battery. So my question is how realistic it is. So to encourage the transition to introduce new technology and to address the challenge we face in the solar power or wind power. So I think the EU has a lot of facility to encourage the innovation through EU EIB, and Japan also has a lot of facility to encourage such sort of the challenge or dynamic transactions. So I'd like to hear the thought from the panelists about the reality on how realistic the innovation is addressing the current challenge post-COVID.
Thanks very much, Hiroki. So, there's a lot of possibilities there. Would anyone like to, any of the panelists want to come in on those points about innovation?
I could make a couple of points.
Please.
There is a lot of capacity for innovation, and actually even it's only 10 years ago that wind and solar were, on average 70% more expensive than they are today. So you have seen an enormous amount of innovation already in a short time. You're absolutely right that you need other aspects in order to make solar investment more sustainable. And hydrogen is certainly potential for the future, as is storage. But actually in the short term, there's investment that's required in distribution networks so that energy that is generated can actually be taken to end consumers and industries, and into transmission grids so that grids are more able to move energy around countries and be stronger to deal with intermittency. And that's where storage can also play, even in a small scale, can actually play a very relevant part. I talked at the beginning about the example of Senegal, where a battery that even is potentially for 4 hours of 60 megawatts, I believe, can actually, support a whole grid in terms of managing the intermittency of the wind. So actually even small scale storage across a grid can be very, very valuable in terms of using more renewable energy. There's also, if you look at, what is going on in Europe, you see Ørsted investing heavily in hydrogen. You see a lot of investment in electric vehicles and electric vehicle infrastructure, and all of those are also aspects that can play their part in terms of low carbon transition. Let me see if other panelists wish to comment.
Thanks, Lucy. I actually was, unless any of you are raring to go, I was going to call on some of our other participants. Okay, you're all right. So potentially, I'm going to pick on you guys. So we'll see who's actually there and who's left, who's left the meeting. Atul, Arya, are you there? Are you there, Atul?
Yes, I'm here. Hi.
Ah, great. Do you have anything to say on this?
Yeah, surely.
Yeah, great.
Absolutely. Well, thank you for bringing me in here. This is very interesting conversation and good to see some good friends on this call here. Hi, Leila. My question is about, we've talked a lot about electricity, but as we know that the decarbonization is a much bigger challenge than just electricity, heavy duty transport, industrial processes. I'm just curious, what is the panel's view on the technologies and then the financing for those technologies, as an example, carbon capture and sequestration.
I can start.
Leila, go ahead.
Okay. Hi, Atul. Nice to see you. I mean, it's true. CCUS more specifically, has been, I don't know whether it's official or not yet, but there is a group of bankers, including APICORP and the World Bank, that are signing a letter that will be, I think, issued in the next couple of weeks on financing principles for CCUS, where we agreed on 10 key principles that will allow CCUS to not only to be financeable, but really to grow at scale, because as you rightly mentioned, that the scale is quite large. And we talk a lot about the electricity sector, but we don't talk about the hard to abate sectors like the heavy industries, the steel, cement industries, and the others like that. So I think from that perspective, hopefully there is a growing awareness. And as I said earlier, if COVID-19 has shown us that we can barely reach the Paris Agreement targets, we are hoping that there will be enough awareness after the hit that we got this year to really get the ball rolling, particularly on CCUS, because indeed it's one of the key technologies that will enable to abate the emissions on the hard to abate sectors, because I think that's more than 60% of the emissions that are coming from outside of the energy sector.
Leila, just for those not familiar with CCUS, what is the usage part of it? What is the emerging innovation in turning it into a viable product?
So, being based in the Middle East, the main application that has actually been sort of economically viable in a way was the use of carbon for reinjection for EOR, for enhanced oil recovery in oil fields. So that's one of the applications that you may have, but there are other applications that are being used for the beverage industry and chemicals, etc. So I think once you, and also of course when you can utilize the carbon, but you can also store it. So that's the other utilization that you can have. Atul, do you want to add something on that?
Well, I was just going to say that, and I'm happy to send this to Chatham House. There was a report published in November of 2016 called Global Roadmap for Implementing CO2 Utilization, if anybody has seen it. This report actually is quite interesting because it laid out, besides EOR, as you said, Leila, concrete, building cement, building material through capturing carbon, and that's a real sequestration of carbon because that's permanently captured. Also fuels, which is not sequestration, but at least reuse, and also things like chemicals and composite materials, for example, for building electric cars. So there are multiple uses, but of course the technologies are not quite mature. And I think one of the things which will be needed is financing for these technologies, because they're going to need, like APICORP or institutions like yours, World Bank, will have to put in money, and private investors, to scale these technologies.
I think there's a really interesting question there, isn't there, particularly for the development finance banks, whether they choose, whether there's a bit of a contest there between choosing to finance CCS or CCUS and choosing to finance a fossil-free infrastructure, fossil-free future amongst consumers. So yeah, I just wanted to bring Patrick in. I know he has a question. Patrick Heller. Please go ahead.
Yeah, excuse me. Thank you, Glada, and thanks to the presenters for really valuable and fascinating perspectives. I just wanted to put a question out to the different speakers to try and build on a little bit of what we've learned from you, and I guess to ask a little bit more explicitly, what if any thoughts you might have on how some of the countries that are represented in the new producers group, countries that are in the early stages of having been investing in trying to develop an oil and gas sector primarily for export in most cases, what would you advise the members of these governments to do in terms of taking advantage of some of the opportunities that you've highlighted, that opportunities over the long financing of renewables look potentially encouraging or more encouraging than being stuck in the in a fossil fuel only model. What would you say that these governments, I don't know, how should they be thinking about what to do from a policy perspective or from a governance perspective to try and take advantage of some of these opportunities, or at least to avoid tripping themselves up as they pursue or think about some of these opportunities? I think your perspectives on how they can engage this evolving marketplace would be really valuable. Thanks.
Thanks, Patrick, and I guess a wide range of answers for a wide range of countries. But if you have specific comments to make, Beth, Lucy, Leila, Paulo, anyone want to come in? Leila?
Just because I'm muted. Well, I just wanted to complement what Lucy said. I think she said an interesting point for utilities, which is renewables, which is the cost-reflective tariffs. And I would apply to the same for oil and gas new producers. It would be market-reflective fiscal terms and prices. So regardless of whether you want to be a small player in the short term, having a short plateau for your oil or gas production. Actually, I think it's much more relevant for oil if you discover oil than if you discover gas. But I think having evolutive market reflexive fiscal terms and not being stuck in a rigid fiscal term that will get you stuck, as you said, in the fossil fuel industry, especially if you are a minor player. I think it's quite key at this stage, because the market will reflect some of the risks that we discussed in this meeting, including the carbon risk, including some of the financial risks that we're looking at. So I think from that perspective, getting away from the old fight between the private sector, let's say, and the host governments, I think is quite key.
Thanks, Leila. Beth, you wanted to come in.
And I think I mentioned when I was speaking earlier, one of the things that governments can think about is what companies think of as above the ground risks. So being easy to deal with, being relatively straightforward. I mean, the resource will be what it is, and you hope it's the best resource it can possibly be. But as Leila has said, if you have realistic contract terms and you're an easy government to deal with, you're much more likely to come onto the yes, we'll go ahead with it list than not. And I think that is something that perhaps governments should think about, a sort of cooperative approach rather than a very antagonistic approach. I think also governments need to think about what's the point of it for us, and where, for example, if we take an economy like Trinidad and Tobago in the 1960s, it made sense to build an entire oil-based industry around their discoveries, oil and gas. So you wanted to build a refinery and a urea plant and an aluminium smelter. I think where we sit now, that's very much not the case, and the answer may very well be take the money and invest it into a better diversified economy, or into a green economy, or into education, or into something else, rather than really, to extend what Leila was saying, becoming trapped in an oil and gas in an oil and gas structure which may not have very much of a future, may not have a longer term future.
Thanks. I think it's a really important point, Beth. Actually, can I just come back to you, Patrick? Because I think that question, and also the point that Beth mentioned earlier in terms of the lack of appetite maybe for buying up oil and gas assets. You know, does this, what do you think this means for contracting and making sure that countries don't become locked into maybe contracts that are no longer beneficial to them as transition takes hold, as markets change and so on?
Yeah, well, definitely one of the challenging questions that a lot of the members of the group have been facing, and you know, there are no real easy answers. I think one of the things that, you know, in the legal working group within the new producers context and in some of the discussions we've been having, one of the things that we've been thinking about is what risk looks like going forward, and you know, and how the balance between trying to capture a share of potential upside and protecting yourselves against, or protecting the country against, the sort of downside risk of what might happen if the industry 5 years from now or 10 years from now looks a lot different than it does today. I think there's no real easy answer, but one of the things, and it connects to what both Leila and Beth have just highlighted, one of the things for us that we've started to think a little bit about is in what ways do contracts between NOCs and their IOC and other partners in new producer countries, in what ways are those contracts taking that risk, right? And so what share of the upfront costs is the NOC bearing? What kinds of other assets is the government trying to build that does depend upon, for success, upon, you know, the idea that oil will be coming out at a certain price level within, you know, in 10 years or so. And so, you know, in the group, we haven't, obviously there's no one answer to this, but what we've been starting to think about and debate a lot more intensively now than a few years ago is, what does that risk return profile look like? And if a government is investing public money today into, you know, infrastructure, the payoff of which is, you know, 5 or 10 years down the road, or if an NOC is investing quite heavily in new exploration or other kinds of you know, upfront costs, I think that the risk return, risk reward analysis needs to look different now than it did a few years ago. And it's one of the things that across the group, the members have, you know, are starting to look at with a little bit more scrutiny than any of us did, you know, several years ago. But I think that needs to continue to evolve for, you know, for everyone.
Thanks, Patrick. And I think it's clear from what we hear from producing countries that they want more information. You know, they want to see much more transparency over what plans investors are making, where they're getting their information, and changing regulation in consuming countries too. Valerie.
Yes, I was intrigued to see that from the panelists and the comments made so far from the different experts involved from the financial sector, that the view seems pretty positive on renewable energy, and to sort of not really see it as a high risk investment. Is that reflective of the financial sector pretty broadly, or is that due to the cast of characters we have here on the screen? I'd be interested to get your viewpoint on whether the tone is pretty reflective of the range of actors, like Beth was talking about, those that are the ethical investors all the way to the, I don't know if you call them the hungry capitalists. But you know, how representative is this optimism about the lower risk of utilities and renewables vis-a-vis oil and gas of the rest of the community?
Thanks, Valerie. Lucy, would you like to?
Yes, I can pick that up. So it's typical, is the short answer, in that if you look at, in comparisons between different classes of infrastructure, even through the COVID crisis, renewable energy has performed well. And contracted energy in particular has been extremely resilient because it does not have typically merchant risk. So in fact, all around the world, renewable energy has been a very attractive asset class for infrastructure investors. And this started originally as, governments started not just in emerging markets, but globally to take steps towards, really bringing more renewable energy into their energy mixes, and also as bond yields and interest rates came down, and renewable energy has become a kind of bond-like opportunity in OECD and other developed markets. So it's general. And then the second point is it actually has performed extremely well, and as a very resilient asset class going forward, precisely because it doesn't typically have a lot of commodity risk, because unless you have a merchant pricing regime, you're fixing a long-term price today that's not subject to volatility going forward.
Thanks, Lucy. Of course, it's a very different business model to what the IOCs are used to, and I think there's a lot of questions as to whether they themselves can reorient their model in the direction of renewables. Maybe other businesses are more suitable for that, for their own diversification. But I think certainly for producing countries, it's interesting because NOCs are willing, they look at lower rates of return and a more long-term mission. I don't know if we have anyone on the call who wants to comment from an NOC perspective. Okay, I will not call you out. Anyone else have any comments on that? I was thinking, Kirsty, are you there? Do you want to say anything about what you hear from European investors?
Hello, I don't know if you can see me. Might be slightly beneficial not to. I mean, I think the views that Lucy was putting forward are fairly reflective of the debates at the moment. I'm a policy person, but I do work around with investors across debt and equity in the renewables and energy transition space. And I think at one level, it is a very detailed debate about what is the regulatory elements of ensuring that things like energy storage and some of the different kinds of what you might call energy transition technologies can participate in the market, and or what's required to create that market, and that can often mean changes that are occurring, year on year. The COVID-19 discussion, I think I'll leave that because I think that's been sort of aired at the beginning of this. But I think there's a lot of optimism. My general feel from what I've spent a lot of time on webinars over the last 2 or 3 months now, and I think there's a general feeling that renewables and energy transition technologies will come back, and people are seeing some very specific impacts, but those are not seen long term. So that's, I mean, I'm just reiterating what's been said. Although, I mean, I think it's important to look really at national level, if not subnational level, to really drill down into what we're talking at underneath the generality. So I would just say that, and there's lots of people on this webinar that would have more interesting things to say on that than I would. So I'll just drop out now. But really interesting discussion, and definitely valued the opportunity to listen and now participate. Thank you.
Thanks, Kirsty. I forgot to say Kirsty Hamilton is one of my colleagues at Chatham House, from an associate fellow from ER. So I don't see any more comments. So I think, yeah, please, Leila.
I'll just add just 2 additional points to complement what was said. I think we didn't talk about 2 points regarding renewables and I think Lucy started hitting at that. the fact that they don't usually bear mentioned risks. They have also usually preferential access, but also the beauty of renewables compared to oil and gas or other, I would say, conventional utilities is that the consumer might start playing a role in the market, which is relatively new especially in emerging markets. So that's, I think, part also of APICORP. We are funding a couple of companies that are leasing solar renewables for especially the commercial and industrial sectors. So these are new business models that are evolving in the region, and I think that's quite interesting.
It just occurred to me, Leila, as well. I mean, there's going to be much more scrutiny, I think, regardless of COVID, on carbon intensity in the sector, both from a perspective of producing less carbon intensive products, but also with the EU planning eventually some kind of border adjustments. I mean, is that do you think some countries are already developing expertise in that area of sort of carbon management? Is that something that you see on the rise in the region?
Is that a question to me?
Yeah, sorry, question to you about the region.
Yeah, no, absolutely. I think there was a report that was done a few years ago when I was with Aramco. I think it showed basically the ranking of different producers, oil producers, carbon intensity of different crudes, and it's clear that the concentration of the lowest carbon crudes are in this region. So I think from that perspective, this has already been taken into account. There is an increase in awareness that has to be taken into account from the oil and gas producers. For the others, as I mentioned early on, there is a readiness that is on the way to ensure that you have green electrons being embedded in any products that you sell, especially if you are indeed dependent on the European Union for your exports and your trade. So you want to ensure that in case of any cross-border taxes, your products are well positioned.
Yeah, I think it's an interesting question for new producers that might have a much higher in carbon intensity compared with the Gulf ones, for instance. Okay, we haven't got much time. We've just got time for one quick question, and I want to come back to Hiroki. Are you there?
Yes.
Oh, hang on. I see also Natome with his hand raised, and so let's have one quick question from each.
Okay, one quick question related to the risk associated with the renewable asset. I would like to ask the currency, because the transaction I was involved in before was all US-based transaction. All tariff was US-based or US fixed price. But usually the tariff in the electricity is local currency. So how do you deal with that, or is there any experience on the local currency based transaction? That would be the very, very core risk, I think. Thank you.
Yeah, I think it's a huge question for investment in renewables. Natome, but let's get your question or comment, and then we'll go back to the panelists. Can you, you have to unmute yourself, Natome.
Bottom left-hand corner.
Can you see it at the bottom of your screen? Great.
Can you hear me?
Yes, we can.
Great. Thank you so much. And I'm glad to have joined this conversation about transitioning from the traditional oil and gas dependence to renewable energy, which also has been relatively with us. My name is Natome Moses, and I'm the County Chief Officer for Water, Environment, and Mineral Resources for the County Government of Turkana in Kenya. Now, you might have heard that already. Kenya recently has joined the League of Nations who are producing oil. And just on the eve of COVID-19, our main oil operator in Kenya, which is Tullow Oil, has been trying to scale down its activities because they already had some other problems with them. Now, COVID-19 has further compounded this. And I'm really glad that now we're having a conversation about how then can we be able to tap into the other renewable energy. Now, Turkana County in Kenya is endowed with a lot of solar energy. And as you can see already on my left side, there's a lot of sun rays. So the question I have for the panelists is, what financing opportunities then exist for a country like us to tap into to ensure that we now, of course, in response to COVID-19, we are able to exploit more on this solar energy that we have in abundance with us? Thank you.
Thank you so much, Natomi. So 2 questions there, and I'll just leave it to Beth and Lucy to make any comments to either or both, because now Leila apologizes and Paulo too, because they have to rush to another meeting. So
I can talk about both of those actually.
Great. Non-convertible currencies and opportunities for a country like Kenya.
So Hiroki, your question was, did we have experience of local currency? And the answer is yes. We have wind farms and solar projects in Brazil and South Africa and India, all of which are local currency markets with local currency contracts. Those local currency PPAs, power purchase agreements, do typically have an escalation component with inflation, and actually over the long term, currency tends to behave with purchasing power parity. So that does give you some currency mitigation. We do see some markets where there's components of local currency exposure, which you can manage through local costs and potentially some local financing. Although if you have a country like Egypt, local currency is relatively expensive. So even though local currency financing in Egyptian pounds is relatively expensive, so you've seen the government choose to have tariffs in dollars because then they can actually have the lowest possible tariffs. And so it's all about the trade-offs. In terms of, Natomi, your question, Turkana actually has a very fantastic wind farm as well, the Lake Turkana project, which is now operating as well. So you have both wonderful wind and solar resources. And actually, I think the Turkana wind farm is a great example because it's been financed by a great large group of development financed institutions. And actually, for a well-structured project, there is plenty of debt and equity available. And the challenge is really, the clear framework and the well-structured project rather than the availability of financing. It is typically development finance, institutional lending, and that's important until a country has managed to get beyond that point of sustainability that both Leila and I talked about, where at that point, like South Africa, there are very strong local institutions who support will provide debt for the power sector, and the debt comes from banks rather than from development finance institutions. So it's really part of the journey in terms of long-term sector sustainability and choosing, DFI financing and potentially guarantee structures to start with, as you then get on the journey to eventually having a cost-reflective sector which can raise debt and equity investment without the need for guarantees or subsidies.
Great. I think we're going to close now. Thank you for those really great questions, and I like the advice that Lucy's proposes. Building your experience, right? Building your reputation will get you a more and more competitive market in the power sector and renewables. Any last words, Valerie, from you? I just really wanted to thank everyone so much for giving their time, especially Lucy, Beth, Leila, and Paulo for agreeing to be on our panel today and really sharing their wisdom and experience. And we do hope to see you again at another NPG group session. So,
thank you.
Thank you, Glada. Thank you.
Thank you. Take care.
Thanks.
Thank you.
Thank you. Thank you very much.
Thank you.